Hello and welcome. Do the ultra-wealthy pay lower taxes than you do? In this video for VuMedi, OJM partner and CPA, Carol Foos answers this question and discusses ways for all taxpayers to create a multi-year plan that can reduce taxable income and maximize tax deductions under the new tax law. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we'd encourage you to check out one of our books, including Wealth Management Made Simple. Click the blue button below to request or download your free copy.
Hi, this is Carol Foos. I'm a CPA and a partner with OJM Group. Today's topic is tax planning for the uber wealthy. We want to address that question of whether the ultra wealthy really pay lower taxes than you do. Truth or fiction? Billionaires pay less in tax than physicians. Generally, I would say this is a false statement. But what billionaires are able to do is use advisors to help them create a multi-year plan in order to maximize tax deductions and reduce taxable income. What do I mean by a multi-year plan? Well, for many taxpayers, this involves planning for things such as the exercise and sale of stock options. It involves planning for ways to utilize operating loss carryforwards. It may even involve creating a charitable giving plan. The key point here is that in planning to reduce taxes, you need to make that plan over the long haul and include not only deductions for this taxable year, but thinking about how your wealth will be taxed going forward. Under the new tax law, not only billionaires can create plans like this, but in fact, taxpayers at almost all levels will benefit from this multi-year planning. Part of this is due to the new standard deduction under the 2017 Tax Act. Starting in 2018, the standard deduction is $24,000 for married taxpayers filing a joint return and $12,000 for single taxpayers. As I'm sure many of you are aware and have read about, state, local, and property tax deduction is now limited to a maximum of $10,000 for joint taxpayers and $5,000 for single taxpayers. There are no longer miscellaneous itemized deductions for tax preparation, investment fees, or employee business expenses. However, taxpayers do still get a full deduction for charitable giving, and in fact, the new tax law increased that deduction so that taxpayers can now write off up to 60% of their adjusted gross income via charitable contributions. So, if you're among the class of taxpayers who perhaps has your mortgage paid off or nearly paid off, your mortgage interest payment maybe is low, then you may be in a situation where your itemized deductions just barely exceed the standard deduction, or maybe they don't exceed them at all. If that is in fact your situation, then one of the things that you should be looking to do is bunching up your charitable contributions. What do I mean by this? Well, it's essentially making 2 years of charitable contributions in one tax year. For instance, instead of making a lot of charitable contributions in December of 2018, maybe I waited and wrote those checks in January of 2019. And I'll make my normal 2019 charitable contributions by the end of 2019. This gives me 2 years worth of charitable deductions in a single tax year. What that allows me to do is perhaps to take the standard deduction in 1 year and get that full $24,000 standard deduction, and then in the following year, where I've got 2 years worth of charitable contributions, I can itemize my deductions and maximize those because now I've got 2 years worth of charitable contributions. So this is a great tool to use if you're facing that prospect of just barely being above the standard deduction, or again, not being above the standard deduction in a given year. There are also some multi-year planning opportunities if you have a pass-through entity. So if your business is taxed as either an S corporation, as a partnership, or as a sole proprietorship, uh, businesses are now eligible for a 20% deduction against qualified business income under the new Section 199A. Now, keep in mind, medical practices are what is termed a specified service trader business under the new tax law, and therefore, if owners of medical practices are above certain taxable income threshold amounts, you may not be eligible for these deductions. But there is some good news. You may be able to use multi-year planning to reduce your income below those threshold amounts, making that specified service trader business a non-factor. And what do I mean by that? Well, you might be able to create some deductions in a tax year, such as investing in depreciable equipment. If you need equipment for the medical practice, you can take Section 179 expense on that equipment, and that will reduce your taxable income. As I mentioned earlier, maybe it's a year to make additional charitable contributions to reduce your taxable income. Another great way to get your income below those threshold amounts, which for 2019 and for a married taxpayer are around $360,000 of taxable income on your Form 1040, you might want to contribute more into deductible retirement plans. So these would be traditional defined contribution and defined benefit plans. If you haven't looked at a defined benefit plan, that's a great way to get a large tax deduction and put away a lot of dollars for your retirement savings. You'll also want to utilize capital losses to offset capital gains in order to reduce your taxable income and possibly get below those threshold amounts. Non-qualified plans are another great multi-year planning tool. Now, non-qualified plans are generally not tax deductible currently. You use after-tax dollars to put money into those plans, but the way that they benefit you in multi-year planning is because distributions from non-qualified plans can be tax-free if the non-qualified plan is properly structured. So again, you want to understand how your wealth will be taxed in retirement. Know that your distributions from any of your qualified plans, so a traditional 401k plan, a defined benefit plan, those will be subject to ordinary income tax rates when you pull them out in retirement. What do the ultra wealthy do? Well, they use multiple buckets to fund their retirement. So consider a non-qualified plan as an asset that can grow tax-free and can have tax-free distributions, which can supplement your qualified plan distributions in retirement. Some advice to consider in thinking about the new tax law and multi-year planning. Most of the individual provisions under this tax law are temporary and they expire after 2025. So between now and the end of 2025, it might be time to fund your Roth account. If you've got a Roth 401k at your practice, it might be a great time to use some after-tax dollars and fund that to build up that tax-free bucket of income. It might be time to fund that non-qualified plan. Again, think about multi-year planning and how are you going to fill up your bucket of tax-free income. And certainly evaluate your choice of business entity. The way your business entity is taxed can be changed, doesn't have to stay that way forever. So think about and work with your personal CPA on the new tax law, the pass-through entity deduction or the lower corporate tax rates for a C corporation and determine which type of entity is right for you. When we talk about tax diversification, we're looking at 3 different buckets of taxable income: ordinary income, capital gains, and tax-free income. And this is a very simplified version of this, but if you think about it, if I've got a bucket of money that's subject to ordinary income tax, I'm approaching a 50% tax level when I pull that money out. This is presuming that by the time you pull the money out, we've reverted back to that top 39.6% federal tax rate. You've perhaps got a 6.6% state tax rate, and you're subject to a 3.8% tax under the Affordable Care Act. So pulling out $100,000 from my qualified plan at that time nets me only $50,000 after tax. If I've got money in my capital gains bucket, I'm more likely to have almost $70,000 left from that $100,000 that I liquidate in retirement. And in my tax-free bucket, for monies such as my Roth accounts or my non-qualified plans, I pull $100,000 out and I get to keep $100,000. It's great to have money spread across these 3 buckets in retirement when tax rates are changing and we don't know what those rates will be or what rates you will be subject to.
OJM is a unique, multidisciplinary wealth management firm. We specialize in working with physicians, and our team has been helping doctors for over 20 years. In fact, we have worked with over 1,000 physician clients throughout the country. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the outset of this video, we encourage you to request a copy of Wealth Management Made Simple, For Doctors Only, or one of our other books for physicians. Our books are available in hard copy, Kindle, and iPad formats. You can get them all for free by clicking the button below. In addition to a free book, OJM Group also offers VuMedi members a complimentary consultation, where we can answer your questions and see if our firm might be a good fit for your situation. Simply click the same button below to schedule your free consultation. Enjoy the free copies of our books, and we hope to speak with you soon. Thanks for watching.